Welcome to this week's Weekly Spotlight, hosted by me, Nicole Weapener, for Share Direct. And we're going to have a look and give you an update on the local and the global markets.
Greetings and welcome to the Investment Focus Club weekly market wrap for the 15th of April 2020. Well, I hope everybody's good and keeping well and safe at home. Sometimes it can be a little bit trying, especially when you have your whole family there. But let's take a look at the markets and distract you for 15 minutes or so. Well, it seems that a retracement is underway at the moment. Overall, we don't want to assume that this is the bottom of the market, as we already know that a bear market works in a series of 3 waves, and the wave that we're seeing right now is the second wave. Now, the second wave is generally a bullish wave, and for this reason, we are now seeing the markets look a lot more bullish than they are bearish. However, don't be tricked into buying or assuming that this market is at the bottom. There's still one leg down to go. So overall, in looking at the world at a glance here, globally, we have indices that are 60% bullish at the moment and 13% bearish. We'll have a look at the sectors that have been rising, and as well as those that are falling amidst the COVID-19 outbreak that we have here. So there are going to be quite dramatic economic effects around the globe. Right, so taking a look at the bullish sentiment from a technical perspective and sorting them out per sector. Let's just do that quickly. Right, so there we can see basic materials. We've got France, Germany and the United States picking up nicely in terms of basic materials, as well as Australia and China not looking too bad. They're bullish. On the construction side, that's the FTSE, that's the UK side. Consumer discretionary goods are bullish in Australia. Consumer goods on the Dow bullish. Consumer services, and there's an uptick on the consumer staples in Australia and China. So that makes sense to me with regard to staples in a crisis situation where we are now. Electronic and electrical equipment, that's on the FTSE 100. That's not looking too bad there. Australia energy, nice little uptick there from last week. Last week's performance 3.53%, so that's quite good. Energy starting to come alive there. Equity investment instruments in the UK, Dow Jones Financials starting to look bullish there. Obviously that's a positive as the dollar is strengthening, and also there's a major flood of liquidity in the market as the Federal Reserve continues to print dollars in the relief funds. Dow Jones Fixed Line Telecommunications, that is USA and UK, looking good there. Food and drug retailers in the UK, a little bit slightly positive there. 2.91% up for the week. Food producers also in the UK looking good. Otherwise, globally, still seem to be under a lot of pressure there, as consumers aren't running out to the retailers to buy their general goods. So there's a general downward trend with regard to that. Germany financials, financial investment companies, not looking too bad there, as well as in the UK. General healthcare starting to pick up quite nicely in Australia there, 4.62% up for the week. Looking at France, general industrials of France, Germany, UK, Australia, as well as China and the USA, picking up nicely. General industrials. Now, this is partly due to, well, this is my opinion, partly due to the reallocation of funding and also ideas, thinking about making masks and producing gowns and that sort of thing. So you're repurposing your business in order to keep the businesses open. So there's a lot of participation with regard to that, instead of just sitting closed in lockdown. So generally entrepreneurs are taking the initiative to create the products that are needed globally amidst this crisis. General mining, a slight uptick there in Australia, China as well, mining and general commodity producers there. General retailers under in China and the UK, they're starting to look a little bit more positive there, more so in the UK than China itself, looking at these numbers here. Dow Jones household goods generally looking good there, 2.29% up for the week. Industrial engineering, the UK, China. Industrial metals in the UK, industrial transport, UK and China, as they're shipping essential products around the world, around the globe. So UK looking very good, positive for the week, 4.46%, while China was slightly down, minus 1.21%. Life insurance in the UK, media in the UK looking very good. Mobile telecommunications, US and China. Oil and gas, bullish on the Dow Jones oil and gas, and the UK oil equipment and services. A lot of strength across the board here. However, it's sparsely spread. It's not globally. It doesn't represent a global recovery as such as a whole, but it's interesting just to highlight those that pop out. There we go. Biotechnology and pharmaceuticals there, very good. In the USA, 6.4% up, and in the USA and the UK is at 5.78%, so that was a nice increase last week, and you can see the daily changes there. That was as at Monday, a nice daily change in those markets. Real estate and real estate investment trusts, still a little bit skeptical about these at the moment, as the housing market still seems to be under a lot of pressure. So, rise like this in the sector, real estate investment trusts, will have to keep a close eye on those ones. Resources under Australia, support services in the UK ticking up nicely there, 3.5%. Technology, obviously technology combined with pharmaceutical companies in the rush to find the cure for the coronavirus. There you can see it picking up. France, USA and China all bullish there, so it seems that a lot of funding will be moving into there. Telecommunications in general, bullish in China and Australia. Travel and leisure, that is still bullish, however slightly down for the week. And also China, as people start to move around a little bit more, there's an uptick there. So hotel and catering particular in China, obviously, because the hotels have been repurposed to accommodate emergency personnel or essential personnel serving those that are affected with the virus. So obviously that's a very good positive input there. Weekly performance up 4.61%. Utilities picking up in the USA, China and Australia in general. So there's just a quick overview of all the sectors and subsectors that are showing bullish signs at the moment. So let's have a look at the performance across the asset classes in terms of commodities, equities, cryptocurrencies and interest rates across the globe. So my performance chart here is arranged into the worst performing at the top and the best performing at the bottom. So it's interesting to see South Africa's 3-month bill, Treasury bill, is at minus 25.93%. Well, that's the weekly performance. And the United States 3-month Treasury bill is at the top of the list. So there you can see the difference between the USA and South Africa just by looking at the numbers there. Now the USA has already dropped their interest rate, so now they are continuing to print money to flood into the system, and by doing that they are then obviously boosting their rate, so the yield is actually going up. So that's why you see a massive percentage like that, 78% for the US right over here, for that weekly performance last week. So the interest rate is still really low. There you can see 0.267. Okay, and ours is sitting at 4 on 3 months. South Africa in general, if you look at the interest rates across the globe, it's still got a very, very high interest rate. Our negative performance here is as a result of the South African Reserve Bank reducing the interest rate yet again by 100 basis points, and there you can see the yield just shot out. But it's just very interesting that the worst performer is South Africa, best performer is United States 3-month Treasury. Okay, so let's see what else is not looking too healthy here. Commodities, Western Texas Intermediate crude oil down again, $22 a barrel. That's down 7%. Bitcoin also not doing too well either. That was down 4.57% last week, and it's basically just trading flat now, or sideways, and is at $6,867 a coin. Ethereum also not doing too well as a crypto, 157.83. That's down 4.18%. So crude Brent oil also down to a lesser degree than Western Texas Intermediate. Brent oil futures is down and trading at $31.52 a barrel. That was only slightly down 1.32%. So the worst affected, that's the group of the worst affected asset classes over the past week. So you see cryptos, oil, and interest rates. So that is like a hot subject at the moment: crypto, oil, and interest rates. China top 50 futures there on equity, that seems to be just slightly bearish. Well, it is still in a bear market. Hang Seng also in a bear market. Shanghai Composite also in a bear market. New gold palladium starting to look a little bit more attractive, as it is at the bottom of the bullish scale here, and a performance of 0.89%. So the new gold palladium ETF should be a nice opportunity for you. Otherwise, equity markets, CAC futures, the Aussie top 40 futures on the JSE exchange basically is neutral. The Nikkei top 225 futures, that's in Japan. FTSE 100 in the UK, the JSE All Share Index, all looking positive, as well as the SP 500 and the Australian top 200 futures. So equity markets across the globe are in a nice little throwback, or a retracement, if you'd like to call it that, to the upside. Okay, but remember, we have officially entered into a bear market, so unless the market continues to move higher and break the previous highs, then you are actually looking at a trend change. Until that happens, you have not reached the bottom yet. So that is the assumption in a bear market. Let's have a look here. Rates, 10-year Treasury bond is 0.74, call it 75%. So that is up 3.11%. And then let's have a look at gold and silver. So silver, nicely bullish there, $15.96 an ounce. That's up 4.50% for the week. Gold futures $1,764 an ounce. That's up 4.89%. So gold and silver looking extremely attractive as a flight to safety continues. Right, so let's put all that into pictures. If we look at the headline indices sentiment across the globe, there we can see general industrials as repurposing starts to get underway. The world actually reacted pretty quickly to the outbreak, so you know there's always a glimmer of light at the end of the tunnel. General industrials are more bullish than bearish at the moment, as well as consumer services. You can see a remarkable change from the previous week's graphs that we had a look at. Financials also looking a little bit more bullish. Resources bullish. Consumer goods, healthcare, telecommunications. So all basically green across the board for the present time. Consumer discretionary and consumer staples are also in the green. Well, here's a picture of the JSE All Share Index, and I zoomed it all the way out to 2005, and it's quite interesting because here we can have a look at the 2008 market that we saw. There was the peak May 2008, actually the 19th of May, where the All Share Index was at 33, and you see how we moved downwards. We moved downwards, and then we had a small little uptick there. Unfortunately, I can't zoom in here, so here's the little uptick that we had. And that is exactly what we're going through at this present moment in time. So there you had the first move down, slight little move up, and then we move down to those lows there that we last saw 2008, 2009. So yeah, quite a dramatic year, 2008. And then we had QE. This is QE all along the way as our markets continue to move higher, and this is where we are today. So we have zoomed out on the chart, and you can actually see the dramatic fall that the all-share index has taken over the past month. So we're looking over a period of 4 weeks here, just in this move over here. So what we're looking at is this little upswing to the upside here. So there was the low. Let's just get down to it here. Get down to it. Around about 40,000. It went to 38. It went lower. That was around the 20th of March. So now present day, yesterday, we're looking at well, Friday the 9th. We closed higher at 48. So 38,000 points back up to 48,000 points. That's a 10,000 point swing in a matter of a week. So this is a nice little throwback that we're seeing here. As you can see, this little period over here was also slightly congested, so that doesn't rule out the possibility that we also might start seeing the development of a bearish flag on the all-share index. So if this is a bearish flag, here's the flagpole. We could see some bouncing around further down the line before you get into the next leg down. Now you can see how dramatic this was. Now it really does look small because the whole chart has been zoomed out, but basically that's quite a large move down, a retracement, and then another leg down. So this is exactly what we're also looking at on the all-share index. That's why I say this isn't the bottom of the market. We're not done just yet, because there we saw 38 around about the 20th, 21st of March, and now we're back up at 48 again. So definitely not a buying opportunity. The market could most definitely move sideways. We'd have to continue to watch the other markets or global markets and see how we can actually cope during this lockdown period, because I think when the reality really sets in of the economic impact, we're going to see our markets really plummet quite hard. So if you are still in stocks, here's your opportunity to get out. Okay, so this is like the final warning to any of those investors who still are adamantly are considering staying in this market, because if this market goes all the way down, we could be looking at it retracing, I'd say a little bit further than the previous highs that we saw 2008. Let me just get there. Very difficult. Right, August 2011, the low was 28,391 on the all-share index. So we're at 48 now. 38 is where we were 2 weeks ago, and 28 is where I think we could be. So my estimate is between 26,000 points and 28,000 points on the all-share index. And if you would like to stay in your stocks, then stay in your stocks until the bottom. Obviously, markets do generally go up, but I think this is a crisis that's going to take quite a number of years, in fact maybe even a decade, to recover from. So it's actually just not worth staying in the market. The buy and hold strategy is completely out of the window. So if you can wait another 10 years to recover and and hope that you might not need that money, because heaven forbid you need the money when we get to this low here at 26,000 or 28,000 points. Heaven forbid you need the money and you need to pull it out of the stock market, and you pull it out of the stock market here, that's where you realize your loss. So that's why I'm saying buy and hold's not going to work here. There's too much uncertainty in the market. We have no idea where the bottom is. This is all my opinion from the analysis that I've been doing, and I'm sharing it with you. I don't know how long the economy is going to take to recover. We had a massive uprun here from the 2008 financial crisis. This time it's the same thing. It is the same thing, but the events and the catalysts which are basically causing this are to a degree much more intense. Okay, so here we had a so-called real estate bubble pop. Okay, in this instance here we have a virus that's threatening the health, safety and security of human beings in general. Life is at stake here, food is at stake here, subsistence, everything is at stake here. So the risks are so much more higher in this market downturn. So there's no guarantee that the recovery after this is going to be this dramatic as we had QE. I mean, who's gonna save the currency, save the global economies? It's not just one economy, it's global economies. Who's going to save them? Who's going to be the lender of last resort if the Federal Reserve is no longer there? The Federal Reserve doesn't actually benefit us here in South Africa, and this is what we need to bear in mind. Yes, our markets do benefit with foreign investment. If the foreign investment isn't there anymore, the outcome or the expectation of having a bull run like this is completely absurd. It's just non-existent. So there's way too much risk here in this market. You are going to need to dip into investments at some stage in the future, and it's better to take profit on an investment, or when you need money at the top, you buy low and you sell high. So here's your opportunity, the last opportunity, I think, to sell high. I doubt that the all share index is actually going to get to a level here that we last saw in November, around about 53,000 points. I really much doubt that. This is the retracement that we're looking at here is potentially between a 38% level and a 50% level on this move that the all share index moved downwards. So the retracement is obviously to the upside, and that's exactly where we are at the moment. So we're at about 38, we're just past the 38, moving up to the 50. I very much doubt that we're going to go to 53,000 points. Even 50,000 is a push at this point in time. So definitely this is the final warning. This is the opportunity of a lifetime to get out of your stocks before you see yourself at 28,000 points on the all share index. Yes, you could argue the fact that yes, you've been in the stocks. If you've been in the stocks for a very long period of time, that's great. You've made fantastic profits, so now it's time to go and redistribute those profits into a different asset class. Definitely. Also, you could argue the fact that you want to stay in the companies because you believe that the companies will recover and they're paying good dividends. Yes, all the dividend yields are looking fantastic at the moment relative to the share price of the underlying company. But if the company doesn't have a current ratio of 18, it's not going to make it, because my estimation is that I'm projecting in 18 months ahead, if a company has sufficient finances to continue, and obviously when we get up and running again, things will start to look a little bit better. I'm saying there is a light at the end of the tunnel, but obviously cash flow is everything here for a company's survival. And if they are not able to have enough income or cash to keep the company running at least for about 18 months, then it's not going to make it. So a current ratio of 18 is the minimum requirement for actually staying or holding on to the stock of that specific company. That's the first aspect. The second aspect is dividend yields are not going to last forever. They look great now, okay, but if the company doesn't have money, remember your dividends come from a portion out of the retained earnings of the company, and earnings are declining because nothing's happening. If the operations aren't running, the company is not making money. So if it's not making money, there's no retained earnings. What is the first thing to go when a company needs money? Well, sorry shareholders, we're not paying out a dividend. So that is a really, really concerning factor. I mean, don't say it's not going to happen. That it happens all the time. This is what the companies do. So this isn't about loyalty to a specific company. This is about preserving your financial wealth, okay, your wealth, and now is the time to switch into a different asset class. With that said, a quick look at commodities, and real money, in my opinion, is gold and silver. So yeah, if you can't hold it, you don't own it. So gold futures, that's moving up nicely. You can see the gold price is $1,764.30 an ounce, and that's just the beginning. Nice performance for the week there, up 4.89%. Silver also a nice run up there, 4.50%, trading at $15.96 an ounce. Interestingly enough, looking at the gold-silver ratio, that's up, just shot out of the ballpark here. Here you can see the price of silver is it takes 123 ounces of silver to purchase 1 ounce of gold. So this big gap that we're seeing here between the price of gold and silver actually shows you how underpriced and cheap silver really is. So that is the most undervalued commodity or precious metal in the world at the moment. So there is a complete mismatch. Once this ratio starts to come down again, you're either going to see a triple or quadruple increase in the silver price, because I doubt the gold price is going to come down. It's steadily rising. Maybe it takes its small little dips. As we have a look on the gold price here, you can see from July 2019, gold price has just been moving up steadily with all these little the major trend is bullish. The minor trend is obviously a retracement that we moved down. So these upward moves, up and down moves on gold, every single opportunity where the market dips back like this is a buying opportunity in the gold and silver markets. So if you are investing as a store of wealth, it's better to buy the physical metal, okay, because the paper contracts, and there's a big difference between the prices on the paper contracts and the physical market. And here, when you're trading the gold futures spot price, that's a paper contract. That doesn't actually mean anything. And from an investor's perspective, you actually want to physically own the metal in order to get the future growth, because this is gold and silver is is an investment that you make in times of uncertainty. And if you haven't noticed whatever's going around us at the moment, there is extreme uncertainty, fear. It's just rife. So where do investors go to when they seek security? They go to precious metals. So this is the opportunity for you. There is still time, because gold is trading at 1,000 on the 4th, 1,649. That was Friday, and yesterday we were looking at 1,764. So that's huge. That's $100 move in gold. Okay, so this is the futures price, and eventually, as the rand continues to weaken, remember gold is priced in US dollars. If the rand continues to weaken, as we're buying gold, we're buying it at the price in US dollars, and that means it's just going to cost us that much more rand to buy that same ounce of gold. So it's not the ounce of gold that's changing, it's the exchange rate between the rand and the US dollar. So that's what's killing us, actually. So if you can buy the physical metal when the rand is strong, okay, you're going to have a double benefit there, because if the rand continues to weaken, then obviously if you bought the gold when the rand was strong, as the rand weakens against the US dollar, if you ever have to sell that metal, then you get that many more rands, because the rand has subsequently weakened against the US dollar. That's on one side of the equation. The other side of the equation is you have the physical metal, it's in your possession, and that is your store of value. So you'll be able to convert that. If you buy bullion, you can convert that to any other currency in the world, okay, at a later stage. So for now, as a safe haven asset, that is why it is seen as the most stable or most prudent opportunity at this point in time. The opportunity on gold and silver. Silver is very cheap at the moment. So basically, you just want to get a truckload of that if you can, right? Because the physical market is also drying up. I mean, you and I are not the only ones that are thinking about this. Okay, so there's a huge demand in the physical market. So that's going to drive up the premiums in the physical market on the gold and silver prices. So the first ones in are the better, are the more prudent investors. So you get into the physical metal, and then you hold it until you see fit that you need to sell it, and because we're going into a bull market in gold and silver. So silver is extremely cheap at the moment, and gold, if you look at the price relative to where the United States Federal Reserve is currently valuing gold at the moment. Let me have a look quickly, I'll show you. So this is the US debt clock, national debt clock, and it shows you the prices of gold and silver. Dollar to silver at the moment, now I've been watching this for about 5 years already, and this started at around $65 an ounce, the dollar to silver. So as the Federal Reserve continues to print money, okay, they're looking at the money supply relative, that's the amount of physical dollars that are out there in the world, okay, relative to the amount of physical silver that is available in the world, okay, and that's how you calculate that ratio. So that's the M2, I think it's the M2 or the M3 money supply versus the physical silver. So if they had to match them alongside one another, and this is where you can see how silver is so undervalued compared to the money supply. This used to be at $65, $85 an ounce. It's gone up in a space of weeks. I'm lying if I tell you it's like 3 or 4 weeks. Now silver is valued at $2,367 an ounce, and that is not the silver spot price at the moment. At the moment, it's trading at $15.96 an ounce. So here you can see that if they had to bring the money supply and the price of silver on equal par, okay, then that is what silver would be priced at. So it is absolutely crazy if silver's trading at $15.96 an ounce, and what it should be, $2,367. Can you see the thousands of percent gain that you can make there? Now, also looking at the dollar to gold ratio, when I started having a look at that back in 2014, this was around $4,000 an ounce, and also in the space of 3 weeks it went from 4,000 to 8,000 to 12,000 to 16,000, and now the dollar to gold ratio is $19,619 an ounce, and gold is only trading at 1,764. So it's already still a huge difference, but the percentage gain on silver is much larger than the percentage gain on gold. Now I'm not saying that they are going to reset it and make the money supply or the fiat currency, the paper money, on par with what gold and silver should be. But in the event that anything like that should happen, gold and silver and gold will jump to these prices and not stay at the current levels that they are. And this is why I'm saying this is the best opportunity, specifically in these times of uncertainty. Well, I hope you enjoyed this edition of the Investment Focus, a weekly market wrap after the Easter weekend. Don't have any buying opportunities except to give you the roundup of the commodities, so at least you know exactly where we are in this moment in time. So do stay safe, find opportunities and things to do in the lockdown. I'm thinking of all of you, and do stay safe. And if you have any comments or anything, you can always put it on the Investment Focus group, and let's have a look at it and have a discussion. And also it's a time to spend with your family and think deeply about your investments and what your plans are for the future. So I hope you guys enjoyed the session. I'll be sending out the video to you shortly, and yes, keep in touch with us on the group or email if you have any questions.